Here's a question that sounds simple but has started more political fights than most any other modern economics. If the government wants more tax, should it raise tax rates or cut them? Your instinct is probably to say raise them. More tax, more money. That's just arithmetic. But what if cutting them actually collected more? What if the rate you charge and the money you actually collect aren't as directly connected as they appear? Well, that's the Laffer Curve. And by the end of this episode, you'll understand why it's one of the most powerful and most abused ideas in economic policy. Before we get into the history and the evidence, we need to establish one distinction that the entire debate rests on. Tax rates and tax revenue are not the same thing. A tax rate is the percentage the government charges. Tax revenue is the actual money that ends up in government coffers. Most people treat these as interchangeable. They're not. And the moment you separate them in your mind, the Laffer Curve stops being a political slogan and starts being a genuinely interesting question. The reason they can come apart is human behavior. People respond to incentives. When tax rates change, behavior changes. People work more or less, invest more or less, report more or less income, move to different jurisdictions, restructure their affairs. Those behavioral responses feed back into the revenue the government actually collects, sometimes in ways that are surprising and counterintuitive. The Laffer Curve is essentially a map of that relationship. Today we're going to understand what it is, where it came from, where it's held up, and where it hasn't. Let's start from scratch with a thought experiment. Imagine a government that sets its income tax rate at 0%. How much revenue does it collect from income taxes? Zero, obviously. No rate, no revenue. That's not controversial. Now imagine the opposite. A government that sets its income tax rate at 100%. Every dollar you earn goes to the government. How much revenue does it collect? Also zero, because nobody works. Nobody starts a business. Nobody reports income. The moment the government takes everything, the rational response is to stop generating taxable income altogether. The activity either disappears or moves underground. So here's what we know just from these two endpoints. At 0%, revenue is zero. At 100% tax, revenue is also zero. Which means somewhere between those two extremes, revenue must be higher than zero. In fact, somewhere in that range there must be a peak, a rate at which the government collects the maximum possible revenue. Plot that on a graph. Tax rate on the horizontal axis, revenue collected on the vertical axis. You get a curve that starts at zero, rises to a peak, then falls back to zero. That is the Laffer curve. Now here's where it gets important. Everything to the left of that peak behaves one way. If you're on the left side, below the revenue maximizing rate, raising rates raises revenue, and cutting rates loses revenue. That's the intuitive world most people assume we live in. But everything to the right of the peak behaves the opposite way. If you're on the right side, above the revenue maximizing rate, raising rates actually reduces revenue because it suppresses so much economic activity. And cutting rates increases revenue because it unleashes activity faster than it reduces the rate applied to it. The entire policy debate about taxes, every argument you've ever heard about whether to raise or cut taxes, is fundamentally an argument about one thing. Which side of that peak are we currently on? If the country is on the left side, raising rates is smart fiscal policy. If it's on the right side, cutting rates is. The math of the curve itself isn't controversial. Both endpoints are agreed upon. The existence of a peak is agreed upon. What nobody agrees on is where the peak is. Estimates from serious economists range enormously. Some place the revenue maximizing top marginal rate about 50%. Others put it closer to 80%. The range itself tells you something important. This is not a settled question. It likely varies by country, by type of tax, by the structure of the economy, and by the time period. There probably isn't one universal peak. There are many, depending on context. That uncertainty is not a reason to dismiss the curve. It's the reason to take it seriously as a framework while being cautious about anyone who claims to know exactly where any given country sits on it. The Laffer curve has a name and a birth story, but the idea behind it is so much older than both. The earliest clear articulation of the concept comes from Ibn Khaldun, a 14th century Arab historian and philosopher writing in North Africa in the 1370s. In his landmark work, the Muqaddimah, one of the earliest systematic attempts at a theory of history and society, Ibn Khaldun wrote explicitly about the relationship between tax rates and government revenue. His argument was direct. When tax rates are low, economic activity flourishes. The tax base grows and government collects substantial revenue. When rates become oppressive, producers are discouraged, the economy contracts, and revenue falls even as rates rise. He connected this specifically to the rise and fall of dynasties, Overtaxation was, in his view, one of the primary mechanisms by which prosperous civilizations destroyed themselves. The idea surfaced again in various forms through the Scottish and French Enlightenments. David Hume touched on related dynamics. The French physiocrats in the 18th century built an entire school of economic thought, partly around the idea that excessive taxation destroys the productive base it draws from. Andrew Mellon, the U.S. Treasury Secretary in the 1920s, argued explicitly that cutting the high post-World War I tax rates would increase revenue by stimulating economic activity. And he was largely vindicated by the data of that decade, though the story of the 1920s is complicated by many other factors. The modern version of the story begins, though, in December 1974 at a restaurant in Washington, D.C. Art Laffer, an economist at the University of Chicago, was having dinner with two senior figures from the Ford administration, Dick Cheney and Donald Rumsfeld. The conversation turned to the question of tax policy and the economy. Laffer, making his argument, reportedly picked up a cocktail napkin and sketched the curve. Revenue on one axis, rate on the other, the arc with its peak. The sketch illustrated his argument that the Ford administration's proposed tax increases might actually reduce revenue by suppressing growth. Whether Laffer actually drew the napkin that night is disputed. Laffer himself has said he doesn't remember doing it, but the story stuck. The napkin became one of the most famous props in economic policy history, and the curve got his name. What happened next transformed the Laffer curve from an economic concept into a political flashpoint. Jude Wanniski, a journalist and political strategist, wrote about the napkin dinner in a 1978 article and then in his book The Way the World Works. He framed the Laffer curve not just as an economic theory but as the intellectual foundation for a new approach to fiscal policy. What would become known as supply-side economics, the argument was bold and simple. Tax rates in the United States, particularly after the increases of the 1960s and 70s, had pushed the economy past the peak of the curve. Cutting them wouldn't just be good for growth, it would actually raise more revenue. Tax cuts could pay for themselves. Ronald Reagan made this argument central to his 1980 presidential campaign. His Economics Recovery Tax Act of 1981 cut the top marginal federal tax rate from 70% to 50%, with further cuts bringing it to 28% by 1988. The Laffer curve went from a sketch on a napkin to the official theoretical justification for the largest tax cuts in American history to that point. And with that, it became impossible to discuss the curve without also discussing politics. Which is a shame, because the underlying idea that behavior responds to incentives and that response feeds back into revenue is genuinely important and genuinely worth understanding on its own terms. Let's look at some of the cases that supporters of the Laffer curve point to and look at them fairly. The United States in the 1920s is actually the strongest historical case and one that gets the least attention, probably because it predates the political battles of the Reagan era. After World War I, the United States had top marginal income tax rates of 73%. Treasury Secretary Andrew Mellon argued these rates were so far past the revenue maximizing point that cutting them would increase revenue. The Harding and Coolidge administrations cut the top tax rate progressively to 25% through the 1920s. What happened to revenue? Federal income tax revenues rose substantially through the decade. The share of taxes paid by high earners actually increased as a proportion of total revenue after the cuts, partly because high earners stopped sheltering income in tax-advantaged vehicles and started reporting it when the rate came down to a level where reporting was worthwhile. This is one of the cleaner illustrations of a genuine Laffer effect, behavioral change producing more revenue at a lower rate. The caveat is real, though. The 1920s were also a period of strong economic growth driven by post-war recovery, technological change, and other factors. Isolating the tax effect from everything else that was happening is genuinely difficult, but the direction of the evidence fits the curve. In another example, between 1996 and 2003, Ireland cut its corporate tax rate from 40% to 12.5%. The results were concrete. Corporate tax receipts more than doubled by 2004, foreign investment poured in, and unemployment fell from nearly 16% to under 5% over the same period. It's one of the most cited examples of a Laffer effect at the corporate level. The lower rate attracted enough additional activity that revenue more than compensated for the rate reduction. The honest caveat is that the mechanism is partly cross-border tax competition rather than purely domestic behavioral response. Multinationals came to Ireland partly because other countries had higher rates. The Laffer logic holds, but it's a different version of it than the theory's original framing describes. Additionally, the Kansas City Federal Reserve study on capital gains suggested that capital gains taxes in particular show strong Laffer dynamics, stronger than even income taxes. The reason is that capital gains realizations are highly discretionary. Investors choose when to sell assets and realize their gains. When capital gains tax rates are high, investors hold assets longer and realize fewer gains. When rates are cut, realizations increase substantially, sometimes enough to offset much of the rate reduction in revenue terms. This dynamic, sometimes called the lock-in effect at high rates and the realization effect at lower rates, is one of the more empirically robust findings in the tax literature. It doesn't mean capital gains cuts always pay for themselves completely, but it does suggest that capital gains taxes are closer to the right side of the Laffer curve than income taxes generally are. These cases share a common thread. The Laffer effect appears to be most reliable under specific conditions, when rates start from a very high level, when the tax applies to activity that is highly discretionary or mobile, and when the behavioral response, reporting more income, relocating capital, increasing investment, can actually occur. Under those conditions, the curve is not a theory, it's an observable phenomenon. The critical question for any real-world application is always, are those conditions present here? That's what we need to ask in Canada in 2026, and that requires also looking at where the curve has not held up. We covered the Reagan cuts in the history segment, but now let's look at the evidence directly. Federal revenues as a share of GDP, the more meaningful measure because it controls for economic growth, remained roughly flat through the 1980s and in some years fell. The federal deficit exploded. The national debt nearly tripled. If the cuts had been self-financing, as the strongest Laffer argument claims, the deficit should have shrunk, not grown. The honest reading is that cutting from 70% probably did recover some revenue through behavioral response. The 1920s evidence suggests starting it from that level is likely past the peak. But the cuts went much further, and the evidence that cutting from 50% to 28% was self-financing is weak. The same pattern repeated with the Bush cuts in 2001 and 2003 and the Trump cuts in 2017. Revenues rose, but so did the deficit each time. None of these cuts were self-financing on any serious analysis. This matters because the self-financing claim is the strongest version of the Laffer argument and the one most often made in political debate. The moderate rate U.S. evidence does not support it. Here at home, between 2000 and 2012, Canada cut its federal corporate tax rate from 28% to 15%. Bipartisan and deliberate, the Chrétien Liberals started the cuts, the Martin Liberals continued them, the Harper Conservatives completed them. Corporate tax revenues held up through the period. On the surface, that looks like the Laffer logic working. But in 2017, Bank of Canada Governor Mark Carney publicly called out Canadian corporations for sitting on what he called dead money. Roughly $500 billion on corporate balance sheets not being deployed into factories, equipment, research, or hiring. It was going into dividends and share buybacks instead. This broke the chain the Laffer argument depends on. Lower rates are supposed to produce higher after-tax returns, attract more investment, creating more jobs, broadening the tax base, and ultimately generating more total revenue at the lower rate. The investment surge didn't materialize at the scale the theory predicted. Employment did grow through the period, but attributing that to corporate tax cuts rather than to oil above $100 a barrel and strong global commodity demand is very difficult. The honest verdict? The cuts didn't produce the revenue collapse critics predicted, but they also didn't produce the investment surge proponents promised either. The transmission mechanism between lower corporate rates and real economic activity is weaker in Canada than the theory assumes. 3 points worth keeping in your head when you hear Laffer arguments in the wild. First, even if the curve is real, applying it requires knowing where the peak is. Serious economists disagree by 30 percentage points or more on that question. If you don't know where the peak is, you can't know whether a cut moves you toward it or away from it. Second, behavioral responses take years to play out fully. A cut that looks like it didn't work after 2 years might show effects after 10, or vice versa. The time horizon problem makes clean measurement genuinely hard. Third, the curve tells you about aggregate revenue. It says nothing about distribution, who benefits from the cut, and who bears the cost if services are reduced in the interim. Critics argue reasonably that treating it as a complete fiscal framework ignores half the relevant question. Here's what to take away from all of this. The Laffer curve is real. The underlying logic, that behavior responds to incentives and that response feeds back into revenue, is not seriously disputed by mainstream economists across the political spectrum. The curve exists, a peak exists. Rates above that peak reduce revenue relative to what could be collected. The strong version of the Laffer argument, that tax cuts pay for themselves, has very limited empirical support outside of cases where rates start from genuinely extreme levels or where the tax applies to highly mobile or discretionary activity like capital gains. For more moderate rate cuts where top marginal rates are already in the 40 to 55% range, The self-financing claim is not well supported by the evidence. For Canada specifically, corporate rates of 15% federally are almost certainly on the left side of the curve. Cutting them further is unlikely to be self-financing. The Canadian dead money episode suggests the growth transmission argument is weaker for Canadian corporate taxes than theory predicts. On the personal income side, high marginal rates in Ontario and Quebec above 50% create real efficiency costs and genuine behavioral distortions, even if they haven't caused revenues to fall outright. The capital gains literature suggests Canada's inclusion rate changes are operating in territory where behavioral responses are significant and worth taking seriously. The most useful thing the Laffer Curve gives you is not a policy prescription. It's a framework for asking the right question. Not, is this tax cut ideologically correct, but where are we on the curve for this specific tax, in this specific economy, right now? And what does the evidence actually say about the behavioral response at this rate level? That question doesn't have a bumper sticker answer, but it is the right one. Well, that's the Laffer Curve, what it is, where it came from, and where it has held up and where it hasn't. If this helped you understand something you've been hearing about in the news or in political debate, share it with someone who's trying to make sense of it too. Also, if you found this video helpful, please subscribe. Hit the notification bell so you don't miss our next brief, and don't be afraid to comment if there's another topic you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.